back with Karl Schamotta, Chief Market Strategist at Corpay. Let's focus on currencies. The loonie is holding up, even though we have an open economy that's vulnerable to any kind of trade war. Karl, why is that? It's mostly U.S. dollar weakness, I take it.
Yes, it is. The big story in town clearly is that the U.S. dollar is depreciating, and that is on the basis of more skepticism about U.S. investments, more skepticism about the U.S. growth trajectory. But there are some positive developments on the Canadian side that are, helping to kind of keep interest rate expectations elevated, right? So on one hand, Canada is now one of the least tariffed countries in the world, right? When we look at it from a U.S. perspective, that's positive. That's certainly something that was not priced in a couple of months ago, or, man, I'm getting confused about time spans now. Sure. It was about a month and a half ago when all this really kicked off. But, that wasn't priced in at that time. We do have, a fiscal stimulus push coming from the government likely that is expected to boost growth. And, that overall is helping to lift the loonie. But there are major headwinds ahead, no question.
Mark Carney, the Prime Minister, is coming under criticism for approving tens of billions of dollars in spending without getting parliamentary approval.
Right. I think the big thing here from a market's perspective is that, that stimulus is welcome at this point, but might not be needed to the degree that it was needed, right? We still have the impact of last year's rate cuts from the Bank of Canada percolating through the economy. We don't have as big a tariff shock as we had been anticipating, even a few weeks ago. And so it doesn't make sense at this point to, unleash the fiscal bazooka at this. And I suspect that ultimately that his government will pull back on some of those plans, or at least deliver them more slowly over time, so that we don't get, sort of an offsetting inflation push in Canada. As you know, looking at yesterday's data, it does look as if, some core pressures from an inflation standpoint are accelerating. And I don't think this government wants to, induce further acceleration there.
What about oil prices? And there's talk of OPEC Plus being interested now in a price war to dissuade U.S. shale producers from growing production.
Yeah, we have a real mess there. So it is increasingly apparent that when you look at Saudi Arabia and the other sort of core countries within OPEC, that they do not foresee a reversion to strong demand and the conditions that existed a couple of years ago. Mm-hmm. And so it does look as if at this point they're just simply looking to maximize market share, deliver a lot of product to market, and suppress any potential competitors down the road. However, you do have some offsets. So what's interesting just in the last 24 hours here is a unsubstantiated story. We're not totally sure whether this reflects actual reality, but that Israel is planning to hit Iranian nuclear facilities. That caused a pretty big jump in crude last night. Surprisingly big jump, actually, I would say. It was
because crude over the past year or so has shown itself relatively immune to Middle East war fears.
Yeah, that's why it's a little surprising. It's odd that markets would have interpreted this as seriously as they did. Perhaps it's like sort of a reflection of a deeper understanding of what's happening, in nuclear talks right now between Iran and the U.S. So it does look as if, Trump wants to make a deal of some sort, and that deal may not be amenable to the Israelis, right? They may not be content that Iran can kind of continue to move down the path toward a nuclear weapon, right? If that's the case, and they want to sort of wreck those talks, that means that, at one point or another, we could be looking at a disruption to supply in the Middle East. Now, of course, this is impacting Brent far more than it's impacting West Texas Intermediate here in North America, because Brent is the global benchmark and used more heavily, I should say, I guess, on global markets. But it is interesting just that reaction function played out the way that it did, given that it's essentially a rumor at this point that Israel is considering this.
Can we talk about patriotism for a second? I was reading a commentary on Twitter today by Arnaud Bertrand, addressing the question of why Europe's tech sector is so much smaller than America's. And he says he started an Airbnb equivalent in Europe.
Right.
But nobody was interested. But then when Airbnb came from Silicon Valley, everybody was excited.
Yeah.
So do we need to be more, and I know this gets very nebulous, but do we need to just stand up for our own tech champions? I mean, why isn't there a Canadian Airbnb, for example?
That's the thing. Like, I think there's sort of two things going on. Well, maybe more, but firstly, you have scale, right? The scale of capital markets, right? The U.S. is one big, giant capital market. It's not, isolated by state. It is just one big market, and so that makes it very different than Europe. Europe is still functioning in the world where each country has its own capital markets. They're not integrated to any huge depth, and they don't look like they're going to be integrated anytime soon. Here in Canada, we're just very small, right? Canada's total market is much smaller than California's when we think about it from an equity standpoint. And so, there's less opportunity there. There's heavier regulation in Europe, arguably heavier regulation in Canada as well when we look down at the province and municipal levels relative to the US. That is an inhibitor to growth, right? And yeah, like at the end of the day, when we have these challenges that are fundamental, you need the desire to overcome them. And in Canada, we just haven't had that. Historically, we didn't pay too much attention to competitiveness, for one. And two, we kept thinking that other things were going to power the economy. So, I think the issue that I've seen over my time in the industry, looking at foreign exchange, is that Canada spent a couple of decades doing nothing but, concentrating on energy, right? It was, as if that was going to be the end-all be-all, and that was crazy given how volatile it is. We then shifted.
You're a price taker, essentially.
Exactly.
Yeah. Sorry.
Yeah, we were a price taker, and that created massive distortions, particularly in the Canadian dollar. I remember, well, you and I both remember when the Canadian dollar was trading above parity, right? That's a huge headwind for Canadian exporters and for the rest of the economy, and so that was an issue. But then after that, we pivoted, and what did we do? We decided we were going to have our own version of a housing bubble, and we put a huge share of national resources into building and renovating houses. And at the end of the day, when you do something like that, that sucks capital away from the productive areas of the economy. So yeah, I think there's those distortions, but also it's that regulatory and the scale issue that are all combining to limit our ability to compete against the U.S. And so we do need to tackle all of those things as strongly as we can in order to build viable alternatives to U.S. markets in the years ahead.
Karl, thank you very much, as ever. Karl Schamotta, Chief Market Strategist at Corpay. Coming up, we are going to bring you a pre-market update. The Open will be right back.